While small-cap uranium miners fight for attention, one heavyweight has already solidified its spot at the top of the nuclear revival: Cameco Corporation, ticker symbol CCJ. As the world's leading publicly traded uranium producer, Cameco isn't just riding the uranium trend, it's shaping it. With deep roots in high-grade mining and expanding global influence, CCJ offers a rare blend of scale, stability, and growth. Nuclear energy is back in the global spotlight, driven by energy security, decarbonization, and electrification needs. And Cameco, with long-term contracts, vertically integrated operations, and geopolitical advantages, sits at the epicenter of this shift. But with uranium prices rallying and CCJ stock already climbing, the question arises, is it too late to buy, or is the best still ahead? In this deep dive, we'll examine Cameco's unique positioning, review its 2024 milestones, explore macro trends, and break down both the bull and bear cases for the stock. Before we dive in, hit that like button, subscribe to Stocks Telegraph, and comment below. Are you bullish on CCJ or betting on smaller miners for a bigger upside? Cameco isn't your average mining stock. It's the global uranium leader with elite assets like McArthur River and Cigar Lake in Canada, two of the highest-grade uranium mines in the world. These mines give Cameco a powerful production advantage with significant cost efficiency and supply reliability. But mining is just part of the story. Through its fuel services division, Cameco manufactures fuel bundles and provides services to nuclear reactors worldwide. In 2024, Cameco cemented its role as a vertically integrated player through its 49% acquisition of Westinghouse, partnering with Brookfield Renewable to connect mining, enrichment, and reactor technology. This deal positions Cameco at the heart of the nuclear value chain. The company's business model focuses on long-term contracts over speculative spot market sales. With over £220 million committed through 2029, Cameco enjoys consistent revenue and less exposure to price swings. This strategy offers a rare blend of stability and scalability, ideal in a volatile sector. In 2024, Cameco showed strength where others faltered. It restarted its McArthur River Key Lake operations, aiming for £15 million annually, while optimizing Cigar Lake at £13.5 million. Unlike peers that flood the market, Cameco maintains supply discipline, protecting both price and margins. Financially, the company delivered $157 million in adjusted net earnings for fourth quarter, with annual EBITDA rising 73% to over $1.5 billion. Westinghouse contributed $483 million to EBITDA, underscoring the value of diversification. Cameco's biggest edge? Trust. With over 3 decades of uranium delivery and partnerships with global utilities, CCJ is the supplier of choice. And its policy alignment is no accident. Cameco is directly involved in government-level planning, offering strategic input into nuclear expansion initiatives. The company's contract portfolio is another standout. Its uranium deliveries average £28 million annually from 2025 to 2029, mostly through contracts with floor and ceiling pricing. This structure offers margin upside while limiting downside. If uranium prices surge again, Cameco's idle capacity and world-class would give it the ability to scale quickly without the risk or cost of greenfield development. This optionality makes CCJ both a defensive and offensive play. Uranium demand is accelerating, driven by energy-hungry AI data centers, national energy security policies, and the transition to clean baseload power. Major governments, including the US, Japan, and EU nations, are extending reactor life, restarting mothballed units, and even stockpiling uranium. On the supply side, there's a crunch. Kazatomprom cut 2025 targets due to material shortages. After a decade of underinvestment, uranium output isn't keeping pace with demand. That's a setup for higher prices. Small modular reactors are also gaining traction, promising scalable and flexible nuclear deployment. This technological push is set to be a major driver of mid-decade demand, and Cameco stands to benefit as these projects move from planning to construction. CCJ sits squarely in this perfect storm. It has low-risk exposure, scalable supply, and global reach, all while the world scrambles for secure, reliable nuclear fuel. In 2024, Cameco posted net earnings of $172 million and adjusted earnings of $292 million. Operating cash flow topped $900 million. That's fuel for reinvestment, dividends, and debt reduction. The Westinghouse deal initially required debt, but Cameco repaid $100 million of its term loan in the third quarter of 2024 and is on track to continue reducing leverage. Liquidity remains strong, with significant free cash flow projected through 2025. Shareholder returns are growing too. CCJ boosted its dividend 33% in 2024 and plans to double it again by 2026. Meanwhile, institutional ownership remains strong. Over 73% of shares are held by big funds like Vanguard, Mirai Asset, and FMR. Cameco has also indicated it will prioritize debt repayment and potential opportunistic share repurchases if cash flow allows. That discipline makes it appealing to long-term investors. CCJ's long-term contracts offer margin expansion as uranium prices rise. Recent contracts include ceilings above $125 per pound and floors around $70, far above decade averages. The Westinghouse deal adds fuel cycle exposure, creating a vertically integrated platform ready to scale. Add in clean energy ETF inflows and ESG mandates, and Cameco has both fundamentals and momentum. Its Canadian base ensures operational safety, regulatory transparency, and political stability, a rare trifecta in the mining world. Plus, SMRs and large-scale nuclear investments from governments worldwide provide multi-decade tailwinds. The company's optionality in scaling output gives it additional upside if demand surges. Delays in SMR adoption or nuclear build-outs could slow demand growth. Regulatory or public pushback remains a wild card. CCJ's mix of fixed-price contracts also means it won't fully benefit from spot price spikes. That limits short-term upside compared to pure-play spot sellers. Also, while its exposure to Westinghouse is a strategic positive, the nuclear services business carries different risks, like slower contract ramp-ups or liability complexity. As of April 2025, CCJ's RSI hovers around 48.4, neutral territory. It trades below its 50-day and 200-day moving averages, suggesting a possible base building phase. Retail sentiment has shifted to smaller uranium names chasing quick gains, but institutions are still accumulating CCJ. With 70% institutional ownership and a consensus price target near $70, Wall Street sees more upside ahead. Insider activity remains quiet, but no major selling, a positive in today's market. And CCJ's inclusion in clean energy and uranium ETFs means it benefits from passive inflows. Cameco is not the flashiest uranium stock, but it's arguably the most complete. With Tier 1 assets, long-term visibility, a diversified nuclear footprint, and policy alignment, it offers rare risk-adjusted exposure to the nuclear resurgence. It may not 5x in a year like a microcap miner, but its chances of compounding value for the next decade are very real. For investors looking for both safety and upside in the uranium space, CCJ might just be the anchor stock you build around. So is Cameco your uranium king, or are you hunting for higher risk, higher reward plays? Drop your take in the comments. We're reading every one. And if you love clean energy, commodity deep dives, and spotting momentum before the crowd, like this video, subscribe to Stocks Telegraph and ring that bell. We'll see you in the next one.